Good evening, ladies and gentlemen. As Roland said, I'm the portfolio manager of Henderson High Income Trust. It's an investment trust that invests in both UK equities, but also bonds as well, which I'll come on to. And I've been involved in the trust for 10 years now, and working with Janice Henderson for over 20 years now. So long established career, I suppose, all relative really. So in terms of the agenda, what am I going to talk about? Probably try not to take up too much time in terms of the actual presentation. The first part really introduction to the trust and talk about some of the nuances from it, explain how we deliver that sort of high income but also growing income stream. Also talk about why we focus on business sustainability in the companies that we invest in, touch a little bit on sort of the longer term performance track record, and then talk a bit more in the second half of the presentation about how we're seeing the outlook for markets and where we see value, certainly within the UK market. So Henderson High Income, I always describe it as the Ronsil of investment trusts, because it does exactly what it says on the tin, and that's to provide that high level of income, but also the prospects of capital growth into the longer term there. I think if the attractions of that income is really shown on the chart on the right hand side there. The red line shows you the dividend yield over time for Henderson High Income, and even though in the short term you've seen increase in interest rates, you've seen an increase in bond yields, the trust at a 6% dividend yield still trades at a significant yield premium to all those other asset classes. So it definitely delivers on the income there. In terms of some of those key attributes for the trust, as I said, it's mainly a UK equity income trust, but it also has the ability to own bonds, and that really is a thing that differentiates us from sort of our peer group. But that should be seen in the context of the gearing of the trust, which I'll come on and describe in a little bit. We are well established, so we launched back in 1989, and we've grown to about 250 million of gross assets. We do take a long-term approach, so typical holding periods for the companies we invest in would be anywhere between sort of 3 and 5 years, sometimes longer, sometimes shorter. I sit within the global equity income team at Janus Henderson, which does have a very strong income heritage, not just running income funds, but also running income investment trusts. So the City of London Investment Trust, Lowland Investment Trust as well. And some of you may have seen who follow the trust, actually this year we've increased our dividend for the 10th consecutive year in a row, which clearly is it's a case of we're not just paying a high dividend income, but also growing that over the longer term. And it's good to see that even through the pandemic we were able to increase the dividend. We've now produced 10 years of consecutive dividend growth. The chart on the right hand side of the screen really shows you the power of both that income and that income growth. So what it highlights is what a £10,000 investment in the trust would have delivered you over the last 10 years in terms of income. And this is assuming no dividend reinvestment. And I suppose the three things that stick out for me is A, over the last 10 years, just in income, you would have earned almost your money back, so 9.4 thousand. That is more than double what you would have got from an investment just in the UK market. And the third point is actually over that time period, the trust has delivered a better capital performance than the underlying UK equity market at the same time. So it's definitely delivering income, but it's also giving you capital appreciation as well. Now I've talked about that one thing that really differentiates us is the ability to own bonds, and that should be seen in the context of the gearing within the trust. So gearing is an element of borrowings to invest in investment opportunities across the floor, and as you can see, the majority of that gearing, so 13.5% that we currently own in the bond portfolio, is backed by gearing in that bond portfolio. So effectively, why do we do this? Currently we can borrow an average blended rate of about 3.5% at the moment. Invest that in a broadly stable portfolio of bond assets, yielding closer to 5%. That's a good way of generating that extra income for the trust, and why the actual dividend yield is so high, relatively speaking. Once you strip out that element of structural gearing within the trust, i.e. that gearing that backs that bond portfolio, the gearing towards the equity portfolio is only around about 7.6%. So much more in line with, I guess, some of the sort of equity-only peer group as well. And that's the kind of point I like to, to make to investors who are looking at the trust is, although on the headline level, the total gearing is at 21.1%, which may be relatively high versus traditional equity-only investment trust. Having the ballast of backing that bonds with the stability of the bond portfolio means that actually the overall volatility of the trust is not too dissimilar. And we kind of show that on the chart on the right-hand side of the page there. This tracks the volatility of the NAV of the trust versus the volatility of the FTSE All-Share. And as you can see over history, actually the volatility of the two aren't materially different. So although we've got high gearing, doesn't mean to say it materializes into high volatility, as we've seen historically. So in terms of what we look for, in terms of the companies in the equities we invest in, I kind of break it down to three main key parts. One is fundamentals, and that's really about understanding a company's key attributes. And the things we're looking for is a good quality business. And what I mean by that is, things that have a robust business model, good market leadership positioning within their industries, high barriers to entry, a strong brand, strong franchises, these sort of things. Really looking for reason to exist businesses. And what I mean by that is, these companies that have invested appropriately to make sure, it's very hard to be competed away, whether that's from their traditional competition or whether that's new disruptive technology. We want our businesses effectively to be around in the next 10 years and in fact grow over that time period. And then the other key attribute we look for is good management teams. I think that's been acutely important over the last few years, really, whether that's steering a business through a pandemic, steering a business through, the supply chain issues we've seen, or the surge in inflation we've seen, and trying to manage your cost base and push prices onto customers. It's been a very difficult environment for business to run effectively their operations, and you need key, very strong, very well experienced, good management teams to run those businesses through those environments. Then we come on to the financials of business, so analysing its financial health. How sustainable are those returns and profits that the company delivers? Can they continue to grow into the longer term? Is a business well invested? The key for us is not just a company pays us a dividend. We want them to fully invest in their business so they can grow into the longer term. So that dividend we get today is not only sustainable, it can grow into the longer term. So it's not about paying all your cash flows out in dividends. It's about investing appropriately in your business and then having a sensible dividend policy coming out as well. And then the last one, I guess, for the financials is making sure the companies we invest in have strong balance sheets. Again, going back to the last few years, it's key to us to have companies that do have strong balance sheets. So when times get more difficult, whether it's a pandemic or whether it's something more or like a pending recession that we're like to see going forward, it's about having that strong balance sheet to see a company through that and actually continue to pay the dividend as well. And then the final aspect of the investment process is really about valuation. It's all very well finding a good quality company with good or improving financials, but you have to be disciplined in terms of the valuation, i.e. the price you pay. If it's already discounted in the share price, actually your capital appreciation is rather limited. It's about finding good quality companies with good or improving financials, but staying disciplined in the valuation and picking up where you think that is not recognised by the current share price as well. I always describe and talk about the sweet spot of dividend yield being a 2 to 6% range. So buying companies that have a yield either at the low end of 2% or at the high end of 6% and everything in between. And these two charts really kind of explain why that's so important. The chart on the left there, what it tries to show you is, be careful what you wish for. The black bars are the dividend yield we were expecting to get. The orange bars are showing you what you actually got at different levels of dividend yield. And as you can see, actually the higher the dividend yield, the less likely you are to earn that. And that's because dividend yield in isolation can be a misleading guide to value. And when you get those really high dividend yields, sometimes it's the market's telling you, A, those dividends are unsustainable and going to get cut, or actually they're just value traps, i.e., your total return over long term is terrible from those types of businesses. That's why we generally search for companies within that 2 to 6% dividend range, because those dividends have proved historically to be very sustainable. Now, clearly at the lower end of that, around the 2%, you probably expect more in terms of dividend growth, and at the higher end, you probably concede a bit less in terms of dividend growth as well. You look to the right-hand chart now, this looks at total returns by dividend yield range. And as you can see, again, that 2 to 4, that 4 to 6% dividend yield range actually produces the best total returns. And that's because dividend yield plus dividend growth are your main contributors to total return into the longer term. Typically, these companies that pay, a good yield, but ones that can grow, actually produce you the best returns. Again, so that's why we look in that sort of 2 to 6% sweet spot for dividend yields. And it comes back to the overall structure of the trust. Having our ability to utilize gearing, invest that in bond assets to boost the headline yield, actually means I don't have to be too aggressive in terms of chasing yield within the equity market. To be too far up the right-hand side of these charts, where again dividends could be unsustainable, and you get into that value trap territory where actually total returns are pretty limited. This is just the track record of the trust since I've been involved. Clearly it's been a good period in terms of outperformance versus benchmark, both in sort of medium and longer term. I suppose what has been quite pleasing is actually, the year-to-date performance of the NAV. We have been in this sort of bear market, lots of worries about inflation, war in Europe, etc., rising interest rates, slowing economic momentum. So it's actually been good, encouraging. The NAV has been fairly resilient and only down 0.7% so far this year to the end of November, which actually outperformed our benchmark there. So that was very much, talking about the trust and introduction. I suppose in terms of the outlook that we're seeing, I've kind of maybe just alluded to some of the points. The outlook is particularly uncertain at the moment. We are going through this cost of living crisis caused by surging inflation in energy, in mortgage costs, etc. And it's very easy to be quite bearish at the moment. And I think sentiment is pretty low at the moment. You don't have to, you don't go too far reading the paper without reading an article about, the cost of living crisis, etc. Yes, times are tough. I recognise that things are slowing. The UK is likely to go into recession if it isn't already. But the point I try and make is not all recessions are equal. And I try to show this on the chart on the right-hand side there. Just the yellow bar, the yellow line there, just shows you the Bank of England's own forecast for economic growth going forward, relative to other recessionary periods we've seen in the last few decades. And as you can see, the Bank of England are actually forecasting quite a mild recession. Now, whether their forecast will be exactly correct, probably not. I mean, they haven't exactly covered themselves in glory over the last 12 months or so. But I suppose, if they're roughly right, and actually there's reasons to suggest actually that any recession could be quite mild. Corporate balance sheets are generally quite strong. Consumer balance sheets are quite strong. There has been this good period over the last 10 years where consumers have paid down their credit card bills, etc., and they can probably consume a little bit more debt now. Labour markets are still very tight. Yes, employment will tick up, but I don't think we'll see the levels we got to, certainly not in the early 90s or 2008. And actually, the banking system is incredibly well capitalised now. So I don't think you'll get this huge credit crisis we saw, again, back in that sort of 2008, 2009 period. So I think that's my starting point is, any recession we like to see is probably likely to be quite mild. The next thing I wanted to talk about was actually the performance of the UK market. Because I think on the face of it, you look at the return of the FTSE All-Share this year at plus 1.8%. Again, you could describe that as being quite resilient, especially when you see the returns you've seen across bonds, across the US market, the NASDAQ, these sort of things that have really been in quite significant negative territory. But there has been a huge divergence within the UK market about the winners and the losers this year. The FTSE 100 is up 6.3%, and the FTSE 250 is down 16.3%. And that gap, that differential between the FTSE 100 and 250, is actually the biggest gap we've ever seen since these indices were introduced back in 1986. So a huge divergence. Interestingly enough, if you were to split the FTSE 100 further, as you can see in the bottom of this table, by the largest 20 companies. Those largest 20 companies are up 17% year to date. Now they're dominated by, big oil, so BP, Shell, tobacco companies, pharmaceutical companies, banks as well. And these businesses have all been pretty strong this year in terms of share price performance. Outside of that top 20 of the FTSE 100, the bottom 80 has actually been pretty weak. Again, sort of down 16%, which is more in line with overseas indices, more in line with the mid-cap. So actually outside those top 20 companies, the UK market's already been quite weak. And I think that's my point. Yes, we're heading to recession. Yes, things are quite bleak out there, but actually markets have already been weak to start reflecting that. And certainly we see that in the valuation. So the chart on this slide just looks at the 12-month forward PE, so the price earnings ratio on the market, both the FTSE 100 and the 250. So across the market cap spectrum, valuations are particularly attractive right now. We haven't seen these sort of levels since the Eurozone debt crisis back in sort of 2010-11. Now, I know we're not back at sort of the GFC lows for the market as a whole, but actually within the market, there are certain stocks which are actually quite close to those sort of valuation discounts. Two such examples I've got here. The first one is Vistry, which is a house builder. It's a good business. It used to be Boversame, but it merged with Linden Homes. And what it has is a lot of affordable housing as well, which I actually think is going to be in a structural growth market over the next decade or so, just because there is such an undersupply of affordable housing going forward. So I think that business will do quite well. And yes, I know, we know mortgage rates have ballooned. We know the housing market is slowing, prices are starting to fall. But don't forget, valuations are discounting mechanisms. You look at where the price to book, so i.e. the valuation the market is ascribing to the land that it holds in its balance sheet, currently at 0.6 times. It's basically back to the lows we saw in the global financial crisis. Now, I know that house price is going to fall, but I don't think we're going to see the huge falls we saw back in 2008. So I think there are anomalies there where we're starting to discount a far too bearish scenario. Likewise, Page Group, which is a recruiter. You look at the valuation, it's trading on EV to net sales, so enterprise value to net fees. That's a typical valuation metric you use for recruitment consultants. Yes, unemployment is going to tick up. Yes, it's probably going to hit their profitability, but that's why the shares have been weak, and that's why the valuation is where it's got to. And again, we're kind of down that low that we got to back in the global financial crisis, which again, I just don't think we're going to see the level of unemployment we did there versus where we are today. So again, two cyclical businesses that have been hit particularly hard on their share prices this year that show very attractive valuations at the moment. This other chart just says, try to hint, what turns the market? Why suddenly why do these valuations in the cyclicals, why are they going to start outperforming? This chart shows you the performance of the FTSE 250, so the mid-cap stocks, inverted, and it's charted against peak interest rate expectations. And that's the one thing that's been driving some of these domestic cyclicals down, is the fact that interest rates have been going up and expectations continue going up. Now, if those interest rate expectations start to fall, then you could argue that will lead the rally in the 250. Now, we started to see it slowly, sort of since the turn of November coming through, but I think you need that to come through a bit more for that rally in the cyclical area of the market to continue and be sustained from here. That's really everything I had on the trust, so I'm happy to sort of open up to Q&A at the moment.
Kicking off, got a few different questions, a few different subject areas, so we might jump around a little bit from subject to subject. The first one came in when you showed looking at the top holdings. Is BAT top holding, is it possible for a UK income fund to have a strong ESG position?
The thing about, I guess ESG means different things to different people. Clearly if you have a strong ESG criteria where you want to invest in a fund that just basically does not invest in typically contentious industries, then Henderson High Income is probably not a trust for you. ESG is still a factor we take into consideration when we go through our investment process. It's integrated in the process. I talked about before about business sustainability. We know there are less smokers in the world than there were 10 years ago. We know there's going to be less smokers in the world in 10 years' time. We engage with the companies to work out what they're doing to protect their business for the longer term. And something like British American Tobacco is investing a lot of money in next generation products, whether that be vaping, heat not burn, modern oral, etc. So we're confident that actually over the longer term, they can transition their business away from traditional cigarettes into less harmful products, but maintain that profitability coming through and the cash flows of the business that continue to pay that dividend and grow into the longer term. So it all depends on what sort of ESG you mean. Again, for us, it's all about integration, ESG into the process, making sure our businesses are sustainable.
Okay. Next question asks about the bonds in the portfolio. What type of bonds do you own? Are these high yield bonds? Are they investment grade? I guess could you explain for those who might not be so familiar with those terms where you are and the characteristic of those bonds?
Yeah, so it's all corporate bonds, and it's a mixture of high yield, so lower rated bonds. Typically, where we own high yield bonds, they are in non-cyclical reasons to exist businesses that can command more debt on their balance sheet but have a lower rating. So telecom companies, typically, things like that. We also own investment grade bonds, so higher rated, good quality businesses. Typically we've gone into the US market for that. So utilizing our ability to go overseas by 30% to own sort of US investment grade bonds. So we're talking companies typically like Nestle, the consumer staples business, Sky TV, we own their bonds. These sort of good quality names that can, that sustain a very good cash flow, and you'd have to, think the world would have to stop revolving for them to not pay their coupons. Those type of businesses.
And has that ever happened? Have you had any defaults or?
No, I mean, on the 10 years I've been on the trust, we've never had a default from any of the bonds we own.
Super. Next question is about the City of London, who you mentioned earlier on. Aside from the bonds, how differentiated is the portfolio to the City of London portfolio?
So I suppose if you look at the equity portfolio of high income relative to City of London, I reckon there's probably a 60% commonality. City of London is very much a large cap trust. Given the size of it, has to be more allocated to large cap. We're a relatively smaller trust, so there is, I've got more ability to go in that sort of mid cap space. So that's why there wouldn't be. That's why the commonality is fairly low, I suppose. But I am the deputy manager in the City of London as well. I sit next to Joe Curtis, so there will be common holdings, especially in that more, I guess, in the larger cap area of the market. But good differentiation, I suppose.
Okay, time for one last question. Is how small do you get then? You said mid cap in terms of market cap size or some names. Where would you?
Yeah, so I'd say 500 million at the low end would be the lowest we'd go to in terms of that market cap level.
Super, David. There we are. We're perfectly on time. Thank you very much indeed for your presentation.
Brilliant. Thank you very much, and good evening, everyone.